Hello everyone. Let's start with day 2 of the session. I hope that you all have done the revision which I told you yesterday. I asked you all people to read out the summary notes and I hope that you all must have done it. Okay. Please respond to me on the question tab that whether you did the homework which I gave you people or not. I asked you people to read out this summary handout. How many of you have done that? Please respond me. Oh, okay. Some students are saying that yes, they did reading. Okay. What about other students? Did you do the reading I told you yesterday? I asked you people that you have to read that summary handout so that you will be doing the past papers and you will be able to understand the past papers in a better situation. Okay. Okay. So some of the students are saying that they have done, but some have not yet done. Anyways, if you have not done that, then try to do the reading of the summary handout by tomorrow or before the tomorrow session so that you will be able to understand the past papers in a better way. Okay, let's move towards the March 2020 past paper which we were doing yesterday. We completed question number 1 in the previous class. I hope you all remember. That was Polly. We discussed the issues involved in that question, and you read out the answer which I have developed for you people. Okay? Now, yesterday we also read question number 2, but due to lack of time, we were not able to do that question, but today we will try to complete question 2, 3, and 4, and let's see whether we will be able to complete it or not. Okay. So let's review the question again. Okay, just give me a second. Some audio issues we are facing because some of the students are saying that there are some audio issues. So we are stopping for 2-3 minutes while the moderator can look at it. Okay, we are stopping for 2-3 minutes due to audio issues. Start resume करूँ. Okay, so let's resume. I hope that the audio issue is resolved by now. Okay. Let's resume with the question number 2 which we read yesterday. Okay, we completed question number 1 in the previous class, and today we are resuming the question number 2 which we read in the previous class. Obviously, today we will review its answer and then we will move towards further questions. Okay. Now, look at what he's saying. I want you all to concentrate on it. Today we will read the requirements and we will solve each and every part specifically. Okay. Okay, let's look at it. Sale of 4,000 shares in Port Limited on 1st May 2020. Sale of 4,000 shares in Port Limited on 4th May 2020. So I think some students are facing audio issues. Okay, is it good now or it was better earlier? Hello everyone, can you please tell, is the audio issue resolved now? Okay, 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 so let's resume. Maybe some connectivity issues. Okay, so maybe things will get better with time passage. Usually do not happens, but as you know, internet is always unpredictable. So there may be some issue. Anyways, let's resume as far as you people can hear and look at the screen which I'm sharing. Okay, now let's resume again. Okay, now we were reading part A of the question, sale of 4,000 shares in Port Limited on 4th May 2000, on 1st May 2020. Calculate Meta's capital gain tax liability in respect of this proposed sale to NED, assuming all available reliefs will be claimed. Okay, what we have to do is calculate Meta's capital gain tax liability in respect of the proposed sale to NED, assuming all available reliefs will be claimed. Okay, we'll go and read it that what is the proposed sale to NED, and secondly, Meta is resident in UK. You should assume she will be a higher rate taxpayer in the year 2020-21, and that CGT annual exemption will not be available to her. Okay, so what we have to calculate is we have to calculate Meta's CGT liability on proposed sale to NED. Okay, assuming that Meta is resident in UK and she is a higher rate taxpayer and she don't have annual exemption available. Okay, let's go and read out the requirement. For this part of the requirement, we are provided with how many marks? We are provided with 4 marks. Sale of 4,000 shares in Port Limited on 1st May 2020. We have to calculate capital gains tax on this part, and we are provided with how many marks? We are provided with 4 marks. Okay, let's look at it. I want you all to concentrate. This was the question which we read in the previous class. Today we are just looking at the solution. Okay, if you all remember, in the previous class I discussed the preparation approach with you, that once you are done with the revision of the course, what you have to do is that you have to do last 10 attempt past papers attempt wise. Do the past papers and follow the summary notes for the revision of rules. Okay, if you haven't revised the summary notes yet, try to do it today or before the tomorrow's class. As I asked you people in the previous class, that try to read out the summary notes which I gave you and I shared on WhatsApp group also yesterday, that these are the summary notes in which all rules of advanced taxation are summarized. Okay, if anyone has missed out these summary notes or he has not got them, so I'll share them on the WhatsApp group again today so that you can access them. Okay, they will be shared in handout section also today. So if you haven't downloaded it yesterday, you can download it today also. Okay, coming back. Now, what was the detail relating to sale of 4,000 shares? Okay, let's look at it. Sale of 4,000 shares in Port Limited. On 1st May 2020, I am going to sell 4,000 shares in Port Limited to my brother Ned. I note from the work you have already done that current market value of these shares is 2,60,000. Is 2,60,000. However, because I'm keen to get Ned involved, I have agreed to a price of 200,000. Ned, who is UK resident, will sign the claim for CGT gift relief. Now, market value of the shares was 260,000. Market value of share was 260,000. We are selling these shares to Ned to 200,000. So this means that there is a gift element of how much? There is the gift element of how much? The gift element is of 60,000. Okay? Now the question is that for how much did we purchase these Port Limited shares? Okay? The detail about the purchase of Port Limited shares is given here. The detail about purchase of Port Limited shares is given here if you look at it. Please concentrate with me so that you can have a better understanding. Now, Meta owns the whole of the ordinary share capital of Port Limited, which is an unquoted trading company. Meta began trading as unincorporated business on 1st June 2012. On 1st April 2015, when the assets of her business were worth 120,000, she incorporated her business by selling all assets to Port Limited in exchange for 10,000 ordinary shares. This sale resulted in total chargeable gain of 37,400, all of which was relieved by incorporation relief. Now, the market value of shares which you got was 120,000. The market value of shares which you got, how many shares? 10,000 shares. The market value of 10,000 shares which you got was 120,000. He claimed incorporation relief of how much? The incorporation relief was claimed of 37,400. So what was the base cost? The base cost of shares will be, can anyone tell me what will be the base cost of shares? 120,000 was the market value minus the base cost, 37,400. So the base cost of shares was 82,600. How many shares? 10,000 shares. How many shares? 10,000 shares. Okay. I'm looking that many of the students are not responding to me on the tab. Please be attentive. Please be participative so that you can learn maximum in these 3 hours. Okay. I want everyone to keep your calculators with yourself. And when I ask any number, I want everyone to calculate it. Okay. Now, what is the requirement? Sale of 4,000 shares in Port Limited on 1st May 2020. How many marks? 4 marks. Okay, let's look at it. Now, the market value of these shares was 260,000. The market value of these shares was 260,000. So where it was given? if you go and look at it, uh, if you go and look at it, here it was given that the market value, the current market value of these shares is 260,000. The current market value of shares is 260,000. Okay, but we are selling them for 200,000. Okay, so DP is equal to market value is 260,000. DP is equal to market value is 260,000 less the cost. So we will get the gain. Okay, so the market value of these shares is, everyone, please participate. The market value of these shares is 260,000. Okay, less the cost. Less the cost. Now, what is the cost of Port Limited shares? If you remember, we just calculated it. Now, when we incorporated Port Limited, the market value of these shares was 120,000. Incorporation relief was 37,400. So, the base cost of 10,000 shares was 82,600. 82,600 divided by 10,000 multiplied by 4,000. So the base cost of shares is 33,040. Okay, so DP is equal to market value 260 minus the cost 33040. The chargeable gain is 226,960. Now, gift relief is available. Gift relief is available on gift element. Now you are giving 260,000 shares for 200,000. So the gift element is 60,000. No annual exemption. Taxable gain is 166,960. And when you charge capital gains tax, the entrepreneur relief will be available. Now, obviously, you must be thinking that, sir, how did you get this entrepreneur relief? So let's look at it. Let's look at it. Now, Mita owns the whole of the share capital of the company. When you own whole of the share capital, this means that your holding is more than 5%. Okay? And Mita is the one which managed that business, because she began trading as an unincorporated business and then she converted it into a company, which means that she also works in the company. And if you also work in the company, you satisfy the condition of being an employee. Okay? Now, one advice for you all. One advice for you all. Whenever you look at sale of shares, one advice for you all. Whenever you look at sale of shares, and if the shares are sold by a company, always think about substantial shareholding exemption. And if the shares are sold by an individual, always think about entrepreneur relief. Whenever you look at sale of shares and the shares are being sold by company, always think about substantial shareholding exemption. If the shares are being sold by an individual, always think about entrepreneur relief. Okay, now here we were selling 4,000 shares. Here we were selling how many shares? 4,000 shares. DP is equal to market value 260. What about the cost? The cost of Port Limited shares. We didn't purchase Port Limited shares, rather we incorporated it. Okay. So market value at time of incorporation minus the incorporation relief, base cost is 82,600. You had 10,000 shares multiplied by 4,000 shares. So this gives you 33,040. Okay. Is that clear, everyone? Yes. Everyone, is there any question? So why entrepreneur relief when the company is unquoted? Answer, entrepreneur relief is available on quoted and unquoted companies both. For entrepreneur relief, the condition is that you should have 5% holding. Your ownership period should be 2 years. You should be the employee of the company and the company should be trading company. Entrepreneur relief is available on both quoted and unquoted. Okay. If you want to revise the rule, you can simply go to the summaries handout and you can look at the rules of entrepreneur relief. Just a second so that you will be confident on using this handout. Okay. Now, just a second. Yes. When we talk about entrepreneur relief, CGT rate is reduced to 10% if transaction is any one of the following: sale of going concern business, sale of ceased business assets, sale of shares in which you are employed, hold 5% shares in company's trading company. Your holding period requirement is 2 years. No need of quoted unquoted. Okay. Okay. Then what? There's one more question. Said that what is SSE? My friend, I'll just take a minute to brief you it. When an individual sells shares, when a human being, when an individual sells shares, they get entrepreneur relief. But when a company sells shares, they get substantial shareholding exemption. The concept of substantial shareholding exemption is that if a company is selling shares, if a company is selling shares of another company in which the holding is at least 10% for 12 consecutive months out of last 6 years, then the disposal gets no gain, no loss. When a company sells shares of another company, they can claim substantial shareholding exemption. Okay? Again, if you want to go and look at the rule in the summary handout, you will simply run to corporation taxes, and in corporation taxes, you will find this topic of substantial shareholding exemption. Yes, here it is. Substantial shareholding exemption. If a company sells shares of another company, then substantial shareholding exemption will be available. No gain, no loss on shares. Requirement is to own 10% or more shares in 12 months out of last 6 years. Okay? So, anyways, coming back to the question. What I want from you all is that you all should be good at this summary handout. Take a leave from your office, take an off for 1 day or 2 and read this summary handout. Take a time tonight and read this summary handout 2-3 times so that all the rules in your mind gets revised. Okay? And if you have missed out yesterday's class, then I'll advise you that go and look at the class 1 of the webinar that is available on Vimeo channel of ACCA. shared you all the link of the recording on the WhatsApp group also. Okay, coming back to the question, everyone, are we good? Is everyone understanding? Please. Okay. Yes, yes, sir. Yes, sir. Yes, okay, it's good. Now let's move to question number 2, which is the main part of this requirement. Okay. Yes, Abdul Wahab, substantial shareholding exemption is part of corporation taxes. Okay. This is what I was saying to the students was that whenever you look at sale of shares, always think about substantial shareholding exemption or entrepreneur relief. Okay. Let's move to question 2. I want you all to be connected with me. Okay. Part B, Quad Limited. How many marks? 15 marks. Part B, Quad Limited. How many marks? 15 marks. Let's look at it. The main part of the question. Explain the tax deductions which will be available to Quad Limited in respect of the scientific research cost of 102,000 to be incurred in year ending 31st March 2021. Everyone, do you people remember the rules of research and development? Do you people remember? So maybe we have forgotten. Okay, let's go and revise it first. Let's go and look at the rules of research and development first. Everyone, please be connected with me. Okay. Research and development. Okay, here it comes. Okay, here it comes. Everyone, please look at it. Research and development. Capital expenditure. Any expenditure having life of more than 1 year will be regarded as capital expenditure. Allowed expense is available 100% immediately from trading P&L. If you'll do capital expenditure, you will get 100% allowed expense. That is the rule for capital expenditures. If you are doing a revenue expenditure, any outflow which is not a capital expenditure is shown as a revenue expenditure. Allowed expense of 100% is available. So this means that whether you do capital or revenue expenditure, normal relief is, if you do capital or revenue expenditure, normal relief is 100% allowed expense. Normal relief is 100% allowed expense. Either you do capital expenditure or revenue expenditure. Okay. Now, additional relief may be available on revenue expenditure. Additional relief may be available on revenue expenditure if it is a qualifying expenditure. What are qualifying expenditures? Consumables, staff cost, agency staff cost, utility expenses, and software. No additional relief if outflow is admin cost, market research, or market research is outsourced. Additional relief is 130% if a company is SME. Large company can claim a 12% refund. Okay, one more thing, write it down. No R&D relief on land. If you purchase a land, you don't get any relief on land. Okay, so now, everyone, please be connected. If you do a spending on research and development, and that spending is a capital expenditure. If you do a spending on research and development, and that spending is a capital expenditure, you get 100% allowed expense. If that spending is a revenue expenditure, you get 100% allowed expense. But if it is a qualifying expense, but if it is a qualifying expense, but if it is a qualifying expense, you get 130% additional relief. You get 130% additional relief. Okay? Come back to the question. You just revised the rules. Now let's go and look at the question. Now, I want you all to concentrate with me. Everyone. Now, I want you all to tell me on the question box, equipment and computer hardware. Everyone, please. Equipment and computer hardware. Is it a capital expenditure or a revenue expenditure? I'm waiting for replies. Yes, sir, it's capital expenditure. So go for 100%. Very good. Material. It's a capital expenditure or it's a revenue expenditure? Sir, it's a revenue expenditure. Plus it's a qualifying expenditure. Plus it's a qualifying expenditure. 100 plus 130. Just a minute, sir. How did you got to know that it's qualifying? Go back to the summary notes. Go back to the summary notes. Read it. Consumables, such as material, is a qualifying expense. Consumables, such as material, is qualifying expense. What I've been trying to say to you people from the start is that these summary notes are detailed and comprehensive. They cover almost, I'll say 99% of the rules. Like 1% is not covered in it. Maybe I've forgotten them while making these notes. But 99.5% is covered. Just read these summaries and then solve the past papers and look at the difference you will feel. Okay? Coming back to the question. Rent. Now, rent is not a qualifying expense. It's a revenue expense, but it's not qualifying. So revenue expense, you'll get 100%. Electricity and water, revenue plus qualifying, because electricity and water are utility expenses. So 100 plus 130. Staff cost, revenue plus qualifying. So 100 plus 130. But if you remember the staff cost, all of the staff costs relate to company employees of COD Limited, with the exception of 7,000 paid to external contractor. Paid to external contractor, which means that we outsourced some of the staff. Go back and look at the summary notes. 65% of the staff cost will only qualify for additional relief if it is outsourced staff. If it is outsourced staff, only 65%. Only 65% will qualify for additional relief. Okay, let's go back to the question. I want you all to look at this. Now we are moving towards the solution, that how we'll develop the answer. Look at it. Now, part B, we are answering scientific research cost. COD Limited will be able to claim allowed expense of following amounts in relation to scientific research cost. The first is equipment and computer hardware. Note 1. Computer and hardware. Note 1. Let's read it. What does note 1 says? Computer and hardware purchased is a capital expenditure. Allowed expense is 100%. So 27,500 into 100% is 27,500. Okay. So for computer and hardware, the allowed expense is 27,500. Number 2, material. Look at note 2. Everyone, material cost qualify for additional relief as it is spending on consumables. As Quad Limited is a small enterprise, for R&D, the additional relief is 130%. So where is this small enterprise written? Go back to the question. Go back to the question. Here it is written. Okay, we read the question in the previous class. Okay, so Quad Limited will be a small enterprise for the purpose of research and development. For the research and development purpose. Okay, they are small enterprise. Okay. Okay. Maria Salim has asked her that how can we expense out the capital expenditure? Maria, this is a relief available on research and development. That if you do a capital expenditure on research and development, you get 100% allowed expense. Okay, this is the relief. In order to encourage research and development activity, HMRC gives you 100% allowed expense if you do capital expenditure on research and development. Okay, coming back to the question. 21,000 is the cost of the material. Material is a qualifying expense, so normal plus additional relief. 21,000 multiplied by 100 plus 130. So the total relief is 48,300. Okay. So the allowed expense for material will be 48,300. Then the rent. Look at note 3. Rent is a revenue expenditure which do not qualify for additional relief. Normal relief of 100% will be available. 17,400, 100%, you will get relief of 17,400. Then electricity and water. Electricity and water costs will be eligible for both normal and additional relief. So 100 plus 130. 6,600, 100 plus 130, you got a relief of 15,180. Then comes the staff cost, the most important one. Staff cost is a qualifying outflow for additional relief. It will be eligible for both normal and additional relief. However, 7,000 of the staff cost is outsourced. Whenever the staff cost is outsourced, 65% of this will qualify for additional relief. Now, the total staff cost is 29,500. The total staff cost is 29,500 minus the 7,000. Why 7,000? Because 7,000 is the outsourced staff cost. So 29,500 minus 7,000, 100 plus 130, this gives me 51750. Okay, now on 7,000 you will get 100%, but on 65% portion you will get 130%. On 65% portion, you will get 130%. If the staff is outsourced, If the staff is outsourced, only 65%, of the staff cost will qualify for additional relief. So for staff cost, the relief is 64,665. The total allowed expense will be 173,045. Let me give you a revision. Equipment and hardware, capital expenditure. Material, normal plus additional. Rent, only normal. Electricity and water, normal plus additional. Staff cost, normal plus additional, but in relation to the outsourced staff cost. Only 65% will qualify for additional relief. Any question? Everyone, please. Any question? Okay, good. Any other question, anyone? Only 4 students have replied to me. That's very sad. Any question, everyone, please? Okay, it's good. Now the students are replying, very good. Okay. Now, so in the first part of the question, in the part B which we are doing, what did he say? Explain the tax deduction which will be available to Code Limited in respect of the scientific research cost. Okay, on 102,000. Okay, Mohammed Umar Noor has asked a question, said that what about 35%? Umar, on 35% portion you will not get additional relief. In case of outsourced staff cost, you get additional relief on 65% only. If you pay something to outsourced staff, the additional relief is only available on 65% portion. What about rest 35%? Nothing. You don't get additional relief on that. The normal relief 100% is available on whole amount, but the additional relief is only available on 65% portion. Yes, Umar, normal relief is available on all outflows. 100% is available on everything except land. Except land, normal relief is available on everything. The additional relief is available on restricted items. Okay, so coming back to the question now. So we answered the first bullet. Now we are moving towards the second bullet. Explain the tax treatment for the proposed purchase of Cloak brand, an intangible fixed asset for £35,000. I have a question for all of you. Do anyone remember the relief of intangible assets? Can anyone tell me the relief of intangible assets? Anyone? Waiting for the replies. No, it's not patent box. It's not patent box. Yes, one student said amortization. Oh, 20% is something wrong. Yes. Now the right answer came. Now, whenever you purchase an intangible asset, you can get amortization expense at higher of 2 things. Higher of accounting amortization, and 4% of the cost. Oh, sir, I don't remember this rule. Now what will happen? Don't worry. Go back to the summary notes. Go back to the summary notes. Here you'll find the rules of intangible asset. Yes, here it comes. If intangible asset is used by a company for trading purpose, then its amortization will be deducted from accounting P&L. So if you would have read the summary handout, as I told you in the previous class, you would have given me the right answer. Okay, let's come back. Let's come back. Now, let's read out the detail relating to cloth brand given in the question. Yes, here it comes. Let's look at it. Purchase of cloth brand. On 1st April 2020, Cord Limited will purchase cloth brand for 35,000. Okay, for how much we'll purchase? We'll purchase it for 35,000. Advice will then be required on how to develop this brand through the use of social media. It is intended that Cord Limited will purchase this advice from a company based outside the European Union where the rate of VAT is 9%. Now he's moving towards something about VAT. We'll look at it later. Let's look if there is anything else given in related to Cord Limited. Yes. I also deducted £1,000 in respect of cloth brand as it will be amortized over a period of 35 years. Now, look at it here, everyone, please. We have to claim amortization, and the amortization is higher off. The accounting amortization is 1,000. He said, I deducted £1,000. I deducted £1,000 in respect of the cloth brand. So that is the accounting amortization. Okay, that is the accounting amortization. Okay, everyone, the accounting amortization is 1,000 and the amortization allowed by tax department is 4% of the cost. So the cost is 35,000 multiplied by 4%. Can anyone tell me what will be the amount? 35,000 into 4%. Into 4%. It's 1,400. Okay, one student said 1,500, my friend, please use calculator correctly. So, what will be the amortization amount? Can you people tell me? We will obviously go for higher off. And yes, the higher off is 1,400. Yes, the higher off is 1,400. We'll go for 1,400, okay? Let's look at it. Let's look at it, everyone. Cloth brand. Everyone, let's look at it. As cloth brand is purchased by Cord Limited, therefore a yearly allowed expense will be available from trading P&L at higher off. Accounting amortization 1,000. 4% of the cost is 1,400. Cord Limited will claim yearly allowed expense against this intangible asset of 1,400 from trading P&L. Was it difficult? Was it difficult? No, if you remember the rule. If you remember the rule, then it's not difficult. But if you don't remember the rule, then obviously advanced tax is a nightmare. So that was I'm saying you continuously. That do the revision of rules. Revise the rules. Okay, you have my summary notes, revise them from whatever tutor you have studied. Look at the register, revise the rules. If you want to ask me about any topic, you all are on my WhatsApp group, you can ask me. Okay, let's come back to the question. Let's come back to the question. Explain the tax treatment of the proposed purchase of clock brand. Okay. Yes, we will deduct 1,400 from the trading P&L. That will reduce our profits. And when our profits will reduce, obviously it will reduce our tax liability also. Okay. Now, let's read the third bullet. Calculate the amended, everyone, calculate the amended budgeted tax adjusted trading loss for Quad Limited for the year ended 31st March 2001, taking into the explanations requested above. Considering the explanations you gave above, what you have to do is that you have to calculate the revised tax liability. Okay? You have to calculate the revised tax liability. Okay? Now, let's look at it. Let's read the third bullet. Now we have to calculate the revised tax liability. I want you all to concentrate on it. Okay. Yes, here is the data given. Everyone? Yeah, I have reopened the camera, the webcam, because some connectivity issues are happening. So I stopped the webcam so that my audio don't get disrupted. Okay. Some connectivity issue going on. These internet connections are always unpredictable. Now, okay, I have calculated Quad Limited's budgeted trading loss for the year ending to be £44,000. Okay, they have calculated the budgeted trading loss for £44,000. When calculating the loss, I deducted the whole of the cost attributable to scientific research cost of 102,000. I also deducted 1,000 in respect of the cloak brand as it will be amortized. So what he has done is that he has calculated a loss of 44,000, but in that he has deducted 102,000 for research and 1,000 for amortization. Okay, but if you people remember, we just discussed that the allowed expense for the research cost should be 173,045. So the existing trading loss which is calculated is 44,000. The existing trading loss which is calculated is 44,000. Research cost already deducted is 102,000, whereas revised deduction is 173,045. So we can get additional deduction of 71,000. We can get additional deduction of 71,000. Okay, we can get additional deduction of 71,000. Everyone? Now, as far as the cloak brand is concerned, allowed expense already recorded for cloak brand is 1000, but the revised allowed expense will be 1400. We just discussed that the 4% of the cost was better. The 4% of cost was better. Okay. So 1400 minus 1000, we can get allowed expense of 400 more. So the amended trading loss is 115445. Any question? Amended trading loss is 115445. Any question? Hello, everyone. Okay, good. So, I think that till now, it was not difficult. We simply did research and development part. We did working on R&D. We talk about amortization of intangible asset, and we calculated the amended trading loss. Okay, now let's go back to the question and look at what he's asking. Explain how much of the COD Limited amended budgeted trading loss will be available for the use by Port Limited. Explain how much of the COD Limited loss will be available to use for Port Limited. What is the value of the loss which we have got? Everyone, the value of loss is 115445. The value of loss is 115445. Now, what he is asking, how much of the loss can be used by Port Limited? I want you all to concentrate on it. I want reply from you people. Okay, let's look at it. What is the holding structure? Yes, here is the holding structure. The planned ownership of share capital of COD Limited is as follows. 60% of the COD Limited is owned by Port Limited. Mr. Beam or Mr. Beam Company will own 30%. CX Limited will own 10%. I have a question for you people. That at 60% holding, can we form 75% group? Because the loss can only be transferred through 75% group. Junaid Anwar is saying yes. Junaid, hello, are you okay? My holding is 60%. How can I form 75% group? Junaid, okay, so obvious answer is no. Obvious answer is no. I cannot form 75% group. I cannot form 75% group because my holding is 60%. Now, if your holding is 60%, you cannot form 75% group. So start thinking that, okay, if there is no 75% group, how can I take the loss relief? So now the concept which should come in your mind should be consortium. The concept which should come in your mind should be consortium. What is the idea of consortium? Now, consortium is a structure when your individual holding is not 75%, but the collective holding the collective holding of 20 or fewer companies becomes 75%. Now, the port limited holding is 60%. CX limited holding is 10%. Now 60 plus 10 is 70. Now if this 30% is owned by Mr. Bean, Mr. Berg, then consortium will not be formed. But if it is owned by BJB Limited, then consortium will be formed. Look at it here. Look at it here. Cord Limited, Cord Limited, Cord Limited is owned 60% by Port Limited. It's owned 60% by Port Limited. CX owns 10%. Now, if BJB Limited owns the remaining 30%, then what will happen? Then what will happen? 60 plus 10 plus 30. The collective holding, what I'm saying, the collective holding will exceed 75%. The collective holding will exceed 75%. Okay? The collective holding will exceed 75%. Are you getting it? Now, I'm repeating it again. We need to take the loss. We need to take the loss of Cord Limited. Our holding in Cord Limited is 60%. Our holding in Cord Limited is 60%. At 60%, we cannot form a 75% group. So we have to go for consortium. We have to go for consortium. Okay? Let's read it. Let's read it. Sir, if I've forgotten the rules of consortium, what should I do? Go and revise the summary notes. Simple as that. Okay? Now, Port Limited holding in Cord Limited is 60%. Therefore, Port Limited cannot claim Cord Limited loss through 75% group, as holding is less than 75%. Port Limited can claim consortium relief for Cord Limited loss if 30% shares of Cord Limited are owned by BJB Limited rather than Mr. Byrne. Because if 30% are owned by Mr. Byrne, then consortium will not be formed. Because we need the companies who have collective holding of 75%. Now, if BJB Limited owns 30% of Cord Limited, then condition of consortium will be satisfied, as less than 20 companies will have collective holding of 75%. Collective holding of Port, BJB and CX will be 100, which will satisfy condition of 75%. Through consortium relief, Port Limited will be able to claim 60% of the Cord Limited loss, as Port Limited holding in Cord is 60%. The maximum loss claim will be 60% of this loss. Is it clear, everyone? Is it clear? Okay, 75% group was not formed because your ownership was 60%. Okay, so please repeat it. Okay, Seth, I'm repeating it again. Listen it carefully. Seth, 75% group was not formed because our ownership was 60%. Okay, at 60% ownership, we cannot form the 75% group. At 60% ownership SAP, we cannot form the 75% group. So another option to take the loss of the company is to go for consortium relief. Another option is to go for consortium relief. Okay, now for consortium, what we need to do is that we need collective holding of 75%. For consortium, we need collective holding of 75%. Now, Port owns 60, CX owns 10%. So 60 plus 10 is 70. Now, if BJB Limited owns the remaining 30, this will get 100, which is more than 75% collective ownership. We can form the consortium. Okay, we can form the consortium. And if we can form the consortium, we can take 60% of the loss. Okay. Now there are two questions. So what if Port has 60, 10 is of CX, but Mr. Berm owns the 30%. Mr. Berm owns 30%. Now, the holding of individual cannot be considered in consortium. In that case, it will be 70. And if it is less than 75, then there will be no consortium. If there is no consortium, then there is no relief. Okay? If there is no consortium, then there will be no relief. Okay? So Jalal has asked, that, sir, we are getting 60% of the loss. What about the remaining loss? Jalal, that loss to be shared by the other two companies, BJ Limited and CX Limited. Okay? Sir, is it compulsory to hold two or more companies, not only one? Junaid, if you would have individually owning 75% shares, Junaid, if your individual ownership would be 75%, you would have formed a 75% group. Since your individual ownership is not 75%, that's why you have to go for consortium. That's why you have to go for consortium. Okay? In consortium, we can have 20 companies which can collectively complete 75%. One student is asking, sir, I didn't get you on 30% BJB. It was written in the question that 30% shares will either be owned by BJB or they will be owned by Mr. Berm. If they will be owned by BJB, then consortium will be formed because BJB is a company. For consortium, we only need companies. If that 30% is owned by Mr. Berm, then they will not be considered in formation of consortium. Okay? I think you have got the answer. Okay, one more question. So what happens to other 40% of the loss? How it will be claimed? My friend, the question asked about the relief for Port Limited. Port Limited will get 60% of the loss. The Port Limited, through consortium relief, Port Limited will be able to claim 60%. The remaining 40% of the loss will be claimed by CX Limited. The remaining 40% will be claimed by CX Limited and BJB Limited. Okay? I can't read your name very clearly. It's Anushlan, I think I have answered your question. Okay. The remaining 40% loss will be used by other share owners. Okay. CX and BJB. Okay. Any other question? Any other question? The question is that how will you claim the loss? The question was that how Port Limited can claim loss relief. The question was that how Port Limited can claim loss relief on Cod Limited losses. Okay, how we can claim the loss relief. So the answer was that we cannot claim the loss relief through 75% growth, as our ownership is 60%. At 60%, we cannot form 75% growth. So we went for consortium. Are we good? Any other question? Please feel free to ask. Any other question? If you don't have a question, write down, okay, sir, we have understood. Thank you, you are great. Write things like that so I get motivated. Okay. Okay. So many students are saying that, okay, understood. Okay, okay, good. Now, let's go back to the question. Let's go back to the question. What he's asking further. Let's look at it. Explain the value-added tax implications. Explain the value-added tax implications of Cod Limited purchasing advice from overseas supplier rather than one based in UK. I discussed overseas VAT rules with you people in the previous class also. It is very simple. It is very simple. We are purchasing advice. Advice means a service. Advice is an intangible item. Advice is an intangible item. It's a service. Okay? For service, the rule is that if customer is VAT registered, then VAT will be assessed in customer country. If customer is VAT registered, then VAT will be assessed in customer country. Now, as Cod Limited is purchasing the advice, so the customer is Cod Limited. The customer is Cod Limited. It is in UK. The customer is Cod Limited. It is in UK, and Cod Limited is VAT registered. So this means that VAT will be assessed in customer country. The customer country is UK. The VAT will be assessed in customer country, and the customer country is UK. Okay, let's read it. Explain the VAT implication of Cod Limited purchasing advice. Advice means a service from overseas supplier rather than one based in UK. Now, Cod Limited is a UK-based company. It is intended that Cod Limited will purchase the advice from a company based outside European Union in the country where VAT rate is 9% rather than standard rated supply from a supplier based in UK. Now, Cod Limited is registered for VAT. Cod Limited is a company which is registered for VAT. Okay, now let's look at it. A very simple answer. Let's look at it. A very simple answer. Look at it. VAT implications of purchase of advice from overseas supplier. Purchase of advice from overseas supplier will be subject to VAT rules of overseas transactions of services. As per VAT rules of overseas transaction of services, if customer is VAT registered, then VAT is assessed in customer country. The VAT is assessed in customer country. In case of Cord Limited, purchasing advice from supplier will be assessed in Cord Limited country, that is UK, as Cord Limited is a VAT registered customer in UK. VAT will be payable on this transaction in UK at time of purchase of service. However, VAT paid will be recovered by Cord Limited later as it is VAT registered. This means that from VAT perspective, it will not create any difference if Cord Limited purchase services from UK based or from overseas supplier. As in both cases, the VAT will be assessed in UK. Let me repeat it for you. Let me repeat it for you. If you are purchasing services, and the customer is VAT registered, the VAT is assessed in the customer country. Now, if you go and look at the summaries, let's roll back to the summaries of VAT. So that I can show you the rules. Look, for services, customer and supplier both are registered for VAT. VAT will be assessed in the customer country. VAT will be assessed in the customer country. If the customer is not registered for VAT, then the VAT will be assessed in supplier country. In our case, Cord Limited is the customer because Cord Limited is purchasing the advice. In our case, Cord Limited is the customer and it is VAT registered in UK. In our case, Cord Limited is the customer and it is VAT registered in UK. So the VAT will be assessed in UK. Okay? I think that this clarifies that if Cord Limited will be purchasing advice from overseas supplier, then this will not create any issues because in case of purchase of advice, in case of purchase of services, the VAT is assessed in the customer country. And as in our case, the customer is Cord Limited, which is a VAT registered customer in UK, therefore the VAT will be assessed in UK. And if you purchase VAT, and if you purchase these services from a UK supplier, then also VAT will be assessed in UK. So from VAT perspective, it's indifferent. No concern will arise. Okay. So coming back to the question, with this, we have answered our 15 marks part. That was Cord Limited. And believe me, I don't think that it was difficult. The first part was research and development. The second part was intangibles. Third part was revised calculation. Fourth part was consortium. and the last part was on VAT. Okay, now if you look at the formation of the question, examiner tests every area in one question. What the examiner areas, he's testing all of the areas in one question. Now that is the reason why I always say to my students that when you do past paper practice topically, what is topical practice? You revise the topic, and you do past paper of that topic. You easily do it because at that time the topic is fresh in the mind. But when you go into the exam, the examiner asks all topics together. Now this is the point where the problem arises. This is the point where the problem arises. Now what the problem is that you are not able to deal with all rules together. So this is the reason why I ask my students always, and I ask you people also, that once you are done with the course revision, then rather than doing topical practice, you should do complete past papers. Because when you will do complete past papers, you will be able to revise all areas of the course. Okay? I told you people in the previous class that give 10 days for the revision of the course. But once you are done with that, read out the summaries which I have given you. Read out the summaries. Do thorough reading. Read them 2-3 times so that all rules get revised in your mind. These are like 40 pages summaries which summarize the entire ATX course. All rules are written on one place, and then start doing attempt-wise past papers. Okay, rather than doing topical practice, try to do attempt-wise past papers so that you are able to do deal with multiple topics at one point of time. I hope that you people understand my approach and you agree that how you have to proceed yourself. Okay. Now Junaid is asking, sir, that the total requirement is of 15 marks. How can we split this 15 marks between different parts? How can we split that between 15 marks? Junaid, you do not have a specified marking scheme for advanced tests. It varies from question to question. Like in this question, research cost may hold 5 marks. The brand part may hold 2 marks. Revised calculation may hold 2 marks. 5, 7, 9. Then consortium part may hold 3-4 marks. And that VAT part may hold 3-4 marks. Okay. One student is asking, sir, that I do not have any other notes from any tutor. Will your summary notes and past paper will be sufficient? Yes, my summary notes and past papers will be sufficient, but I hope that you must have prepared yourself earlier from some tutor or from the book. So what I want from you people is that first you revise your words, like you revise the book if you are reading the book, if you are following any tutor, whether he's an approved learning provider or not. Revise your register first. Then read out the summary notes so that you revise the whole course in one place. And then start doing the attempt-wise papers. Okay? Moving towards part C, Ride Limited. Moving towards part C, Ride Limited, I want you all to concentrate on it. Okay? Now, Explain why profits of RIBE Limited are subject to UK corporation tax. Explain why profits of RIBE Limited are subject to UK corporation tax. Let's go and read about RIBE Limited. Let's go and read about RIBE Limited, okay? Let's go and read it. On 1st May 2020, Port Limited will purchase the whole of the share capital of RIBE Limited. For the purpose of UK tax, RIBE Limited is resident in UK. RIBE Limited trades through permanent establishment. Permanent establishment means a branch in the country of Tirona. Can you people tell me that what is the tax treatment of a branch? Can you people tell me? Can anyone tell me that what is the tax treatment of a branch? Yes. Syed Jalal has responded that, sir, in case of branch, it is subject to UK tax. Yes. Sir, branch is taxed in normal way in UK, that it's a part of UK. Okay? Because branch is not a separate entity. My friend, branch is not a separate entity. The profits of branch are taxed in a normal way as the UK profits would be. Only difference is that you will get double taxation relief if you have paid any overseas tax. You will get double taxation relief if you have paid any overseas tax. Okay? So the profits of the branch will be subject to normal tax in UK. RIBE Limited budgeted taxable profit for the year, all of which relate to its activities of Tirona, is 75,000. RIBE Limited has no other source of income and is not expected to make any chargeable gains. Once we are confident of profitability in Tirona, RIBE Limited will establish permanent establishment in 2 other countries. Fair enough? Now, RIBE Limited has not made election to exempt the profits of overseas permanent establishment. Okay, just a second, the screen is getting updated. RIBE Limited has not made an election to exempt the profits of its overseas permanent establishment. So this means that if they have not made the election of exemption, then it will be taxed in a normal way. Okay? The rate of corporation tax in the country of Tirona is 14%. Other than that, tax system in Tirona is same as UK. There is no double tax treaty between UK and Tirona. Now look at it, what he's asking. Explain why the profits of RIBE Limited are subject to UK tax. The profits of RIBE Limited are subject to UK tax because RIBE Limited is a UK-based company. RIBE Limited is a UK resident company and it is operating a branch in Tirona. Okay, the profits of the branch are subject to UK tax in a normal way. Okay, sir, are these rules written in your summary notes? Yes. Go to my summary notes. We will go in corporation taxes. We will go in corporation taxes. And here it comes. Operating overseas business. You have 2 options. Go for a branch, or we call it as a permanent establishment. Same as UK entity, no separate entity. It will be taxed as a UK entity. Tax on profit, relief on losses, and capital allowance will be available. However, an election is available through which overseas branches will get exempted. This election is irrevocable and applies to all overseas branches. Now see, if you have read the summary notes, then this part would be so simple for you. This part would be so simple for you. Explain why the profits of RIBE Limited are subject to UK tax. They are subject to UK tax because RIBE Limited is a UK resident company and it has a branch in Tirona. The profits of overseas branch are taxed in a normal way in UK. Okay? I think that's clear. Calculate RIBE Limited expected tax for the year ended 31st March based on the information available. Very simple. The profit is 75,000 multiplied by 19%. 75,000 multiplied by 19%. So the tax is 14,250. Then you will claim DTR, double tax relief. UK tax is 14,250. The tax in Tirona, the rate of tax in the country of Tirona is 14%. So 75,000 multiplied by 14%. So it's 10,500. Simple. It's 10,400 or 500. 10,500. So you will get the tax. Simple as that. Okay. Now, what else he's asking? Discuss the advantages and disadvantages of RIBE Limited making an election to exempt the profits of its permanent establishment. If you go for exemption, the benefit will be that then you don't have to pay any tax on the profits of the overseas branch. The benefit will be that then you don't have to pay any tax on overseas branch profits. But the disadvantage will be that then you will not be able to claim the loss relief also. You will not be able to claim the loss relief also. The advantage is that you don't have to pay the tax. The disadvantage is that you will not be able to claim the loss relief also. And the election is irrevocable. If you make the election once, you cannot revoke it for lifetime. Okay? So let's read it. 6 easy marks. 6 easy marks. Okay? Let's read the answer. RIBE Limited. Evelyn, you have asked a question. Just give me some time. I'll answer you once I read the answer. I'll give you the reply for your question. RIBE Limited is a UK resident company. Therefore, it has to pay UK tax on worldwide profits. Branch in Tirona will be considered as part of RIBE Limited, as branch is not a separate entity. Branch limiteds will be considered as part of overall profits. Okay? RIBE Limited is a UK resident company. Its profits will be subject to UK tax. Okay? UK tax liability of RIBE Limited will be 75,000 into 19%. Double tax relief is lower of 2 things, UK tax and overseas tax. Now, one student, Evelyn, has asked a very good question. Now, this is a confusion to many students, and I would want to clear this confusion now. It is written in the question, if you read it carefully, there is no double tax treaty between UK and Tirana. Evelyn is asking that, sir, if there is no double tax treaty, then why are you claiming double tax relief? Listen it very carefully. Evelyn, if there would have been a double tax treaty, listen it very carefully. If there would have been a double tax treaty, then you would not have claimed DTR. When there is a double tax treaty, then you don't claim double tax relief. Sir, what do you mean by this? My friend, what do double tax treaty do? The double tax treaty eliminates double tax. If there would have been a double tax treaty between UK and Tirana, the treaty means the agreement. If UK and Tirana would have a double tax treaty, then what would happen was that either UK or Tirana would have waived their tax. Listen it very carefully. If there would have been a double tax treaty, what is a treaty? Treaty is an agreement. If there would have been a double tax treaty, then either UK or Tirana would have waived their tax. And if either one of them would have waived their tax, then there would not be any double tax and there would be no double tax relief. As there is no double tax treaty, this is the reason why that both countries are charging the tax. You paid 14% in Tirana and you paid 19% in UK. When there is no double tax treaty, you pay tax in two countries. And when you pay tax in two countries, then you get double tax relief. Evelyn, have you got the point what I'm saying? I'm repeating it again. If there would have been a double tax treaty, listen it very carefully. If there would have been a double tax treaty, then none of the countries would have exempted the tax. Because if there would have been a treaty, if there would have been an agreement, one country would have taken the tax and another would not have taken. So there would be no double tax and there would be no double tax relief. Okay, I'm repeating it again. When there is a treaty, you don't charge double tax and you don't get double tax relief. Because if there would have been a treaty, one country would have taken tax and another country would have waived it. If there would have been a treaty, if there would have been a double tax treaty, one country would have taken tax and other would have waived it. If one country would have taken the tax and other would have waived it, then there would be no double tax and no need of double tax relief. But when there is no treaty, the tax is charged in two countries and then you need double tax relief. Okay, so Evelyn, you have got it. You said that, thanks, sir, I've got it. Anyone who has same question and has not got this issue cleared can ask me again. Because this is the issue which confuses many students. Because students think that double tax relief will only be available when there is a treaty. That is completely wrong. If there would be treaty, there would be no double tax. If there would be a treaty, there would be no double tax. And if there would be no double tax, then what's the need of DTR? Okay, coming back to the answer. Okay, so the first part was that Wright Limited is a UK resident company. Therefore, it has to pay UK tax on its branch profits. Because branch is a part. Branch is not a separate entity. You pay normal tax on branch profits. Okay. Number two was UK tax liability, 75,000 into 19%. The UK tax was 14 to 50. You paid 14% tax in Tirona. So at lower off, you get the double tax relief. So your tax payable is 3750. Then he asked that if Ride Limited will make election to get its overseas establishments exempt, then what will be the advantages and what will be the disadvantages? The advantage would be that you would not be required to pay any UK tax. The advantage would be that you would not be required to pay any UK tax. Advantage will be that no UK tax will be payable on overseas branch profits. This means that additional UK tax of 5% will get exempt because UK tax is 19%. UK tax is 19%, whereas overseas tax was 14%. So through DTR in UK, you was paying 5% more. That will not be payable, it will get exempt. No additional UK tax will be payable if you go for exemption. If you go for exemption. What will be the disadvantages? The advantage will be that no tax on profit. Advantage will be that no tax on profit. The disadvantage will be that there will be no loss relief. If later overseas branch will suffer loss, then loss relief will also not be available. The disadvantage will be that this election will apply on all branches and it is irrevocable. Like for example, in future, if you want to revoke this election, you will not be able to revoke it. It is binding forever. Okay? It is binding forever. You will not be able to revoke it. You will not be able to change the election. And if there will be any loss in any future period, you will not be able to get the loss relief. I hope that this clarifies. So, if you look at this question of 25 marks, what I feel is that it was not a difficult one. What I feel is that it was not a difficult question. What you need to understand is that you have to revise the entire course and you have to attend some complete papers. In part A, there was some gift relief involved. In part B, there was research and development, amortization of intangibles, consortium relief, and VAT. And in part C, we had overseas branch issues. Is it clear? Are there any questions that you want to ask? Okay, very good. Very good. Students are saying that, okay, it's clear. Now see, I'll ask you the question again, which I asked you at the end of the question 1. Do you think your preparation for the exam is complete? Have you revised everything? So obviously you'll say no, that sir, still our revision is going on. But see, when we are doing a past paper, you are able to do it. What is the purpose of this practice to pass session? I want to increase your motivation. I want to increase your confidence. And I want you all to move towards the past papers. What the students do is that they just waste their entire time in revising the course. Now listen it carefully. Advanced tax is so big course. It's like a sea. It's like a pool. When you reach till the end, You miss out the starting ends. When you like for example, if you revise CGT, you revise IHT, you revise VAT, then you'll start to feel that, oh, I've forgotten the CGT again. And in this way, you will only keep doing revision. You will never be able to go towards past papers. So what I want from you people is give 10 days to the revision, revise it, read summary notes 2-3 times, do the revision. And then after that, don't waste your time in revising the rules again and again. Give the time to past papers. Okay. Junaid is asking, sir, is it beneficial to start the question from start? We have to do in the sequence, or we can change the sequence. Junaid, my advice is that always start with question 1. And anything which you feel difficult, leave the space for that. Rather than running throughout the question, it's not good. Start with the question 1. Start with the question 1. No need to read the entire paper. Start with the question 1. If you feel that any requirement, you are not able to do it, leave 2 pages for that and move forward. Okay? Harun is asking, sir, do we start with reading of the requirement? Harun, yes, you can do that. You can do that. Okay? You can read the requirement first and then you can read the question. Okay? Now, let's move towards question number 3. That is Thomas. But before that, I'm taking a break because we have been continuously studying for more than 1.5 hours. Okay. Okay, just a minute. Shahzad has asked, sir, can we write on the question paper and then for analysis? Yes, Shahzad, you can write on the question paper in the exam. You can do the annotations. Okay, you can do the annotations. But obviously, Shahzad, I don't advise that you do this much detailed annotations. You can simply write the short bullets for annotation so that while answering the exam, you can pick up the rule. Because doing so detailed annotations have no issue, but they will waste your time. Just write small rule. Like for example, if you have identified amortization, you can just write amortization, accounting amortization, cost 4%, so that you just remember the rule while you are answering the question. Okay. One student asked me, sir, that can we write the exam answer in this way? Yes. These are the exam answers. They are perfectly okay. You will answer your exam paper in the same way. Small bullets, small points, small commentary. This is what we do. Okay. Now, let's go for a small break. It's 10:21 on my side. We will resume around 10:35. And then we will move towards the question number 3. Take a break, get yourself refreshed, and then we'll move towards question 3. Okay? Okay, so let's resume. Is everyone back? Okay, good. Let's start this question. Okay, question number three, Thomas. Let's read it what it is saying. Thomas requires advice. Thomas requires advice on the tax implications of commencing to trade, the choice of accounting date for his business, and whether or not to register voluntarily for the VAT purpose. Eins. His wife requires advice on the tax implication of selling shares in respect of which relief has been obtained under enterprise investment scheme. Okay, so now basically there are rules of tax implications for commencing to trade. Number one, choice of accounting date. Number two, whether or not voluntarily register for VAT. And then there is some issues of enterprise investment scheme. Okay, let's read it. Thomas is UK resident and domiciled. Thomas uses his CGT annual exemption amount every year. This means that annual exemption is not available. Okay, it is already used. He already uses the annual exemption. Receives dividend of £2,000 every year. Thomas sale of sporting memorabilia. Thomas started selling items of sporting memorabilia from his collection during the tax year 2018/19. During tax year 1890, he started selling some sporting memorabilia. HM Revenue and Custom agreed that these sales should be subject to CGT in the tax year 2018/19. In April 2019, Thomas started purchasing and selling more items of sporting memorabilia, such that HMRC have said that he will be regarded as trading with effect from 6 April 2019, which means 1920. Now, if something comes in the concept of trade, if something comes in concept of trade, the impact will be that we have to pay income tax, we have to pay national insurance contributions on that. Thomas will not be required to register for VAT for the foreseeable future. This means that there is no compulsory registration. Okay? Now, Thomas will, however, consider registering voluntarily for VAT if it is financially beneficial for him to do so. If it is financially beneficial, he will go for voluntary registration. Otherwise, he is not compulsorily required to go for registration. Okay? Now, Thomas expected trading results from sale of sporting memorabilia. Thomas is considering either a 31st March or 30th April year end for his business. Now, if you all know basis period calculation rules, if you all know basis period calculation rules, if you go for 31st March year end, you will not have overlapping profits. But if you go for 30th April year end, you will have overlapping profits. I'm repeating it again. If you will go for 31st March year end, if you will go for 31st March year end, you will not have overlapping profits, because 31st March means that you are aligned with the tax department. If you go for 31st March year end, you will not have overlapping profits. But in case of 30th April year end, you will have 1 month left after first assessment, and you have to create the overlapping periods. Thomas estimates that his total income less expenditure for 12 months ending 31st March 2020 will be 11,500. Each item of memorabilia is purchased and sold for no more than 1,000. All of the costs he incurs are deductible for tax purposes. Thomas expects his profits to increase steadily after 1st April 2020. Earns. Earns is UK resident and domiciled. Earns is a higher rate taxpayer. Earns has made a will, has made / will make no disposals for CGT other than described below. Other than the below disposal, she will not make any other disposals. Sale of painting. Anne sold a painting on 4 July 2007 for 196. The sale gave rise to a gain of 86,000. Acquisition of shares in Tevira Limited. Anne subscribed £72,000 for 20,000 shares on Tevira Limited on 8 October 2017. She sold the painting on 4th July. She sold the painting on 4th July and she invested the proceeds in shares. These shares qualify for enterprise investment scheme. Do you people remember? Do you people remember EIS, CGT, reinvestment relief? Do you people remember the CGT reinvestment relief? The CGT reinvestment relief is that you dispose any asset in this world. You dispose any asset, like it's a painting, a house, shares, anything. You get a gain. You invest your proceeds in EIS shares. Lower off the gain and the reinvestment will get deferred. Sir, I don't remember the rules of EIS. Can you please show me the rules? Yes, I'll show you a very good table which I have made for you people. A very good table. Okay, just a second. Tax reducers. Yes. Look at it. If you invest in EIS, there is income tax relief. There is CGT reinvestment relief. Lower off will get deferred gain and reinvestment. When you invest in EIS, the lower of gain, the gain and the reinvestment amount, lower of amount will get deferred. Now, this is where my summaries will be very helpful for you, because you have all rules written in one place. You just need to read them out and you will have a good revision. So what he is doing here, he sold a painting. He sold a painting for 196 and he reinvested 72,000. Okay, now these shares are qualifying for EIS. These shares are qualifying for EIS. Now, I'm selected to defer the maximum possible amount of the gain on sale of painting against acquisition of the shares. He gave you a clear hint. Defer means you want to go for CGT reinvestment relief. He gave you a clear hint. Then INS obtained EIS relief of 18,600 against her income tax liability for the tax year 2017-18. When you invest in EIS, you also get income tax relief. When you invest in EIS, you also get income tax relief. So it is clearly written that Heinz took income tax relief of how much? 18,600. Heinz intends to sell all of the shares for 95,000 on 1st June 2020. Heinz intends to sell these shares on 1st June 2020. For how much? For 95,000 pounds. Can you people hear me? Hello? Okay. Because the internet signals are dropping, so I'm closing my camera. Okay, yes, you people are hearing. Okay, it's good, it's good, it's good. Loud and clear. Okay, okay. Now, if undertaking, this sale will qualify for entrepreneur relief. The sale of EIS shares will qualify for entrepreneur relief. Now, you purchased EIS shares on 8th October 2017, but you will sell them in June 2020. How many year holding? October 18, October 18, October 19, but you sold it in June 20. You are selling EIS shares in less than 3 years. You are selling EIS shares in less than 3 years. Now, if you remember the rules of EIS, it is mandatory that minimum investment tenure should be 3 years. In case of EIS, it is mandatory that minimum investment tenure should be 3 years. Now, if you will sell within 3 years, what will happen is that your EIS relief will get withdrawn. If you will sell within 3 years, what will happen is that your EIS relief will get withdrawn. Okay? So, what he is doing is that he is planning to sell these EIS shares for 95,000 on 1st June 2020. He purchased in October 17 and he's selling in June 20, less than 3 years. So the income tax relief and the CGT relief you got will be reversed and the gain will also get chargeable. Are you getting it? Okay. Again, I'll give you the same advice. Read out my summary notes thoroughly. Read them 3-4 times. Because once you will read the summary notes, the entire rules, the total rule bank of advanced taxation course will get revised in your mind. Okay, let's move to the requirement. Part A, 5 marks. On the assumption that Thomas prepares his first set of accounts to 31st March 2020, explain with supporting calculation the difference in total amount of tax payable by him for the tax year 2019-20. As a result, the profit on sale of sporting memorabilia treated as trading income rather than chargeable gain. 5 marks. Sale of sporting memorabilia was earlier taxed as chargeable gain. But from tax year 2019-20, the HMRC has said to Thomas that they will tax it as a trading income. That they will tax it as a trading income. What will be the impact on your total tax? Let's go back and read the question. Now, Now, if you remember, it was written that each item of memorabilia was purchased and sold for no more than £1,000. Each item of memorabilia was purchased and sold for no more than £1,000, which means that it was less than £6,000. Both cost and DP. Both the cost and DP both were less than £6,000. If you remember the capital gain tax, if anything has both cost and DP below £6,000, it gets exempt from CGT. If anything has both cost and DP below 6,000, it gets exempt from CGT. The sporting memorabilia, please listen everyone. If the sporting memorabilia was subject to CGT, there was no CGT on them. Why? Because the cost and DP was below 6,000. But if it will be taxed as a trading income, then we have to pay income tax plus we have to pay class 2 NIC plus we have to pay class 4 NIC. If something becomes trading income, you pay income tax, you pay class 2 NIC, and you pay class 4 NIC on it. If something goes for trading income, you have to pay different items on that. On trading income, you pay income tax, you pay class 2 NIC, and you pay class 4 NIC. But if it is subject to CGT, then as per CGT rules, if cost and DP are below 1,000, then there is no CGT on it. Are you getting it? Okay, now, either we will have a 31st March year end or we will have a 30th April year end. Okay, now, Thomas estimates that his total income less expenditure for 12 months ending 31st March 2020 will be 11,500. Now this total income less expenditure will be covered through personal allowance. This total income less expenditure will be covered through personal allowance. Okay, very easy 5 marks. On the assumption that Thomas prepares his first set of accounts to 31st March, explain with supporting calculation the difference in total amount of tax payable in 2019-20 as a result of profit on sale of sporting memorabilia being taxed as trading income rather than chargeable gain. Now, when they were taxed as a chargeable gain, what was happening? Let's read the answer. When sale of sporting memorabilia was taxed under CGT, no tax was payable as their cost and DP both was below £6,000. If a chattel has cost and DP below 6,000, then it is exempt from CGT. What is a chattel? Chattel is something which is tangible plus movable. Sporting memorabilia is a chattel as it is tangible and movable. Its cost and DP is less than 1,000, which is below £6,000 threshold. What I personally think, in advanced taxation, the key to passing the exam is that the rules should be coming very rapidly in your mind. And this only happens when you read the rules again and again, again and again. For that, I told you, read the summary notes like 10 times, 20 times. Read them continuously so that the rules get established in your mind. Now, if the sale will be regarded as a trade, then income tax and NIC will be payable. Income tax and NIC will be payable. Income tax for Thomas in the tax year 1920 will be zero, as profit from sale of 11,000 will be covered through personal allowance of 12,500. You already have a personal allowance of 12,500. If the profit from sale of sporting memorabilia will be 11,500, you don't need to worry, because your entire profit will be covered through personal allowance. Okay? Now, other income of Thomas is a dividend of 2,000, in which 1,000 will be covered through remaining personal allowance, because your personal allowance is 12,500 and your income is 11,500. So 1,000 will be covered through the remaining personal allowance, and 1,000 will be subject to 0% bank of dividend income, which is of 2,000. So this means that in 2019-20, you don't need to pay any tax. In 2019-20, you don't need to pay any tax. Okay? Now, Class 2 NIC is payable. Class 2 NIC is payable because Class 2 NIC is irrespective of the profits. £3 per week into 52 weeks. Now the rate of Class 2 NIC is given in the tax rate sheet. The tax rate sheet will be available to you in the exam. Okay? I hope you all remember the tax rate sheet. You all remember the tax rate sheet, which will be available to you people during the exam, which includes the rate of Class 2 NIC, £3 per week. Okay? Class 4 NIC, till 8632 the rate is 0%, and then from 8633 till 50,000 the rate will be 9%. So if these profits, if your profits will be regarded as a trading income, you have to pay Class 2 NIC of 156 and you have to pay Class 4 NIC. Now your trading profit was 11,500. Your trading profit was 11,500. Now, on 8632, 0% gives you 0. And on the remaining amount, you pay 9%. So this is your Class 4 NIC. If sale of sporting memorabilia is regarded as trade rather than CGT, then in tax year 2019-20, the additional tax will be Class 2 NIC and Class 4 NIC. So if I revise it, listen it very carefully. When the sale of sporting memorabilia was taxed under CGT, please listen. When sale of sporting memorabilia was taxed under CGT, there was no tax payable on it. Why? Because both cost and DP both the cost and disposal proceed of sporting memorabilia was below 6,000. Both cost and DP was below 6,000, as it was written that their cost and DP will be £1,000. When both cost and DP was below £6,000, this means that it was exempt from CGT. This means that it was exempt from CGT. But when it will be regarded as a trade, you have to pay income tax, you have to pay class 2 NIC, and you have to pay class 4 NIC. You have to pay class 2 NIC, you have to pay class 4 NIC, you have to pay income tax. Now the income tax will be zero because the sporting memorabilia will generate the trading profit of 11,500. Now profit of 11,500 will be covered through personal allowance. However, there will be class 2 NIC and there will be class 4 NIC which will be payable. Is it clear, everyone? Any question? Is this clear? Any question? Please ask me. Everyone, please. Understood? Clear? Yes? What about the other 42 people? Have they gone to sleep? Clear? Understood? Yes, understood, clear? Okay, good. This means that things are going in a better direction. Okay, so, see, I'll say you this again. I'm with you for 5 days. Today our second day will end. After today, there will be 3 more days. But what I want from you people is that you should give daily some time to do attempt-wise past papers. Carry on your revision, but do the attempt-wise papers also. Read out the summary notes and carry out the attempt-wise papers. At least do 10 attempt papers 2 or 3 times. At least. And then you will feel the difference, that your confidence of dealing with the rules will increase. Okay? Let's go back to the question. Let's read it. Identify Thomas basis period for the tax year 2020 and 21. Just a second, the screen is getting updated. Some connectivity issue going on. Just 1 minute. Yes. Identify Thomas basis period for the tax year 2020-21 if he adopts the year end of 31st March or 30th April, and state 2 tax advantages for Thomas of adopting 30th April as his year-end date. Now, a very simple part. If you listen to me carefully, it's very simple. If you go for 31st March year-end, there will be no overlapping profits. If you go for 31st March year-end, there will be no overlapping profits. Why? Because in case of 31st March year-end, you are aligned with HMRC. But if you go for 30th April year-end, your first tax assessment will be till 31st March, and then 1 month of April will be remaining. Due to that 1 month of April, you will go back 12 months and you will create a new tax period again. So in case of 30th April year end, you will have maximum overlapping profits. In case of 30th April year end, you will have maximum overlapping profits. Now, if you remember, it was written in the question that Thomas expects that his profits will rise in future. If you expect that your profits will rise in future, always remember, if you expect that your profits will rise in future, it is always advisable that you should go for overlapping profits. One student is saying, sir, please repeat. Okay. What I am doing is that before repeating it, I'm opening basis period rules in front of you so that you can understand it in a better manner. Okay. Now, yes, here are the basis period rules. Yes, let's read it. Just a second when the screen gets updated. Yes, now the screen is ready. Now, opening year. First tax period is till nearest 31st March. Always remember. First tax period is always till nearest 31st March. If all months of first accounting period are not covered, then create a second tax period by going back 12 months. Now, if your accounting year end is 31st March, the tax period will also be till 31st March and there will be no overlapping issue. If your accounting year end is 31st March and tax year also ends on 31st March, you are aligned, there will be no overlapping. But if your year end is 30th April, then what will happen? The first tax period will be till 31st March, but 1 month of April will remain untaxed. Now, what the tax department will do is that they will create a second tax period by going back 12 months. As a result, there will be overlapping profits. The first year profit will be taxed twice. Now, first accounting period year end, if kept as 31st March, then there will be no overlapping, will arise as accounting date is aligned with the fiscal year. However, if end date of first accounting year is 30th April, then overlapping will be maximum as due to 1 month of April, whole new tax period of 12 months will be created. Whole new tax period of 12 months will be created. Now, if first period profits are low, then overlapping profit is beneficial as same profit will be taxed again, and as a result, high profits of second period will be taxed with delay. If your profits are in rising trend, then it is better that you get your first period taxed twice through concept of overlapping. However, if first period profits are high, then overlapping is not preferred as it will lead to too much double taxation. Further, it also improves budgeting as you know your profits, which will be taxed. So, if Thomas will go for 31st March year end, everyone, please listen to me. If Thomas will go for 31st March year end, then there will be no overlapping profit because you will be aligned with the tax year. But if you will go for 30th April year end, what will happen is that due to 1 month of April, what will happen is that a complete new tax period of 12 months will be created. A complete new tax period of 12 months will be created. Your first year profits will be taxed twice. Now, as it was stated in the question, if you go and read the question, it was stated in the question that Thomas expects that his profits to increase steadily after 1st April 2020. What the Thomas expects is that his profits will rise in future. Now, if Thomas expects that his profits will rise in future, if Thomas expects that his profits will rise in future, then obviously getting your first year profits taxed again will be beneficial. So that the second year profits, which are higher profits, gets taxed delayed. Let's read the answer. You will get more clarity. Let's read it. Let's read the answer. You will get more clarity. Now, part B. Thomas' business will be subject to trading income rules from 6 April 2019. Thomas' business will be subject to trading income rules from 6 April 2019. Now, this means that 2020-21 will be the second fiscal year of the business. Okay, now from 2019-20, from 2019-20, they will go to trading income rules. Okay, now if the year end is 31st March, the things will remain simple. Your tax assessment will be from April to March. There will be no issues of overlapping. The things will move forward. The things will move forward. But if your year end is 30th April, what will happen? Your first assessment will be till 31st March. And as 1 month of April will be remaining, you will go back 12 months. You will go back 12 months. As a result, your first period will be taxed twice. I'm repeating it again. If you will follow a 31st March year end, the things will remain aligned. Your first tax assessment till 31st March 20 and then till 31st March 2021. No overlapping. The things will remain aligned. If you will follow 31st March year end, the things will remain aligned. But my friend, if you will go for a 30th April year end, what will happen is that your first tax assessment will be till 31st March. 1 month of April will remain untaxed. Due to that 1 month of April, you will have to go back 12 months. Your first period will be taxed twice. Your first period will be taxed twice. If year end is of 30th April is adopted, then in fiscal year 2021, profits of 1920 will be taxed again due to concept of overlapping profits. If you follow the 30th April year end, what will happen is that your first tax assessment will be till 31st March. What will happen is that your first tax assessment will be till 31st March, but 1 month of April will be remaining. On-site is asking, sir, why tax twice? Try to understand. Please, I'm repeating it again. From April 19 till 31st March 20, you went 12 months. But if your year end is 30th April, then obviously 1 month of April is remaining in your accounting period. Now, due to that 1 month of April, the tax department will send you back 12 months. They will ask you to make a second tax period. And that second tax period will be made by going back 12 months. When you will go back 12 months, see, the 2019 year is taxed twice. Okay? As profits are in rising trend, therefore paying tax on old profits is beneficial. If you will pay the tax in second year also on first year profits, as the profits are in rising trend, therefore paying tax on old profits, which are lower profits, obviously it is beneficial. The higher profits of second year will be taxed with delay. Further, paying tax on old profits also improves cash flow budgeting as old profits are already known. Okay, so this all was written, this entire planning was written in the summary notes. If you go for 31st March year end, you are aligned with tax department. If you go for 31st March year end, you are aligned with tax department. When you are aligned with tax department, there is no overlapping. But if you go for 30th April year end, your first tax assessment will be till 31st March. Due to month of April, tax department will ask you to make a second tax period by going back 12 months. So this means in the second year also, the first year profits will be taxed again. Okay. Yes, Junaid, this is a full mark scoring answer. Sir, in 2020-21, and in 2021, 30th April 2020 to 1st May 2019 will be taxed. Okay. So in this case, this will be taxed, but in this case, the 2021 is being taxed in which the profits are higher. Okay. So I hope that action, your answer is covered. Okay. So what was the question? What was the question? The question was that identify Thomas' basis period for 2020-21 if he adopts 31st March or he goes for 30th April. Always remember a very simple approach. If you go for 31st March, you are aligned with tax department. If you go for 31st March, you are aligned with tax department. There is no overlapping. The things will move forward. But if you go for 30th April, there will be overlapping. Due to 1 month of April, the old profit will be taxed again. The old profit will be taxed again. Okay. Now, as the profits are in rising trend, so getting your old profit taxed again is beneficial. I hope that this clarifies. Okay. Now, let's read part 3. Explain 2 matters which Thomas should consider in deciding whether or not it will be financially beneficial to voluntarily register for VAT. Now, what are the benefits of getting voluntarily registered for VAT? Now, if you get voluntarily registered for VAT, you will be able to recover your input tax. If you get registered for VAT, you will be able to recover your pre-registration input tax. Okay, so simple knowledge, you can find it in your summary notes that what is the benefit of getting yourself voluntarily registered. Thomas should consider that if he gets voluntarily registered for VAT, then he will be able to recover its VAT paid on raw material if it is standard rated or zero rated. Okay, if you get registered for VAT, then you will be able to recover your input tax. Another factor to consider is that whether customers of Thomas are VAT registered or not. Because if your customers are VAT registered, then you should also get registered for VAT. Because once you get registered for VAT, you will charge VAT on them. So if they will be registered for VAT, then they will be able to recover the VAT they are paying to you. I'm repeating it again. If your customers are VAT registered, If your customers are VAT registered, then you should also get yourself VAT registered. If your customers are VAT registered, then you should also get yourself VAT registered. Because if you will get VAT registered, you will charge VAT on them. And if they will also be registered for VAT, then they will be able to recover the VAT you are charging on them. Okay? If Thomas customers are VAT registered, then they will be able to recover the VAT charged by Thomas on sale if Thomas gets VAT registered. If Thomas customers are not registered for VAT, then it will increase their cost if Thomas charges VAT on them. So if your customers are registered for VAT, you should also get yourself registered. If your customers are registered for VAT, you should also get yourself registered. Because if you charge VAT on them, they will be able to recover it. But if they are not registered, then you should also not get yourself registered. Because otherwise it will increase their cost. So I think the very simple part on voluntary VAT registration, not a big deal. And then the last 7 parts explain the tax implications for earnings of her intended sale of Tevira Limited shares on 1st June 2020 and calculate her after-tax proceeds from this sale. So a very simple question, if you remember the rules of EIS, I told you that Heinz purchased these shares. Heinz purchased these shares in 8th October 2017. And if she will sell it in June 2020, if she will sell it in June 2020, what will happen? If she will sell in June 2020, this means that she is selling within 3 years. And if you sell EIS shares within 3 years, your reliefs will get withdrawn. She claimed income tax relief of 18,600. That will also get withdrawn. He is selling these shares for 95,000. She is selling these shares for 95,000. She purchased it for 72,000. So there will be a gain also of like 23,000. Plus, he deferred some gain of painting also. That was a gain of 86,000. She also deferred some gain of painting also. Deferred gain will get chargeable. The deferred gain will get chargeable. There was a gain of painting which she deferred against the EIS shares. If you remember, she sold a painting and then she reinvested in EIS. She sold a painting and she reinvested in EIS. So that deferred gain will also get chargeable. So what you need to understand is that if Heinz, now read it, as Heinz is selling Tevira Limited shares on which EIS relief was claimed within 3 years, therefore, what will happen? Within 3 years, she is selling the shares. So what will happen? Gain on disposal of EIS shares will be chargeable. Income tax relief given on purchase of EIS shares will be withdrawn. And the deferral relief which you claim on purchase of EIS will also get chargeable. The gain on disposal of EIS will also get chargeable. The income tax relief will also get withdrawn. And the third thing is that the gain which you deferred of the painting will also get chargeable. will also get chargeable. Okay, now what was the gain on disposal? You are selling the shares for 95,000. The cost of shares was 72,000. So this gain is 23,000. First of all, this gain will get chargeable. The gain on disposal of EIS shares. Number two, the income tax relief will also get withdrawn. Where it was written that there was income tax relief? Where was it written? If you go and look in the question, it was written here. Eins obtained relief of 18,600. Eins obtained relief of 18,600. Eins obtained relief of 18,600 against her income tax liability. Now, as you are selling the shares within 3 years, therefore income tax relief will also get withdrawn. Number one, gain on disposal of EIS shares will get chargeable, on which you will get entrepreneur relief. Number two, the income tax relief will get withdrawn. And number third, the gain of painting. I sold a painting on 4th July for 1,96,000. For 1,96,000, the sale gave rise to a gain of 86,000. The sale gave rise to 86,000. Now gain was of 86,000, which was the gain of painting. That gain will also get chargeable as you are selling the EIS shares within 3 years. As you are selling EIS shares within 3 years. So number one, the gain on disposal of EIS shares. Number one, gain on disposal of EIS shares. Number two, income tax relief claimed will get withdrawn. And number three, the gain on sale of painting of 86,000 was deferred against purchase of EIS shares. That gain will also get chargeable. Now your gain on painting was 86,000, whereas your investment in EIS was 72,000. So obviously the deferral you claimed was 72,000. So now what is the situation? When you are selling the EIS shares, you have gain on sale of shares 23,000 and you have a deferred gain of painting which is getting chargeable. You are getting two things chargeable. One is the gain on sale of shares and one is the gain on painting. Now the gain of shares is eligible for ER. It is written in the question, and obviously the painting is not eligible for ER. So we will use our annual exemption against the non-ER gains. I hope you all remember. We always use our annual exemption against the non-ER gains. The entrepreneur relief gain will be taxed at 10% and non-ER gain will be taxed at 20%, because in question it was written that we are higher rate taxpayer. So what is the after tax proceed? You sold Tevira Limited shares. You sold Tevira Limited shares for 95,000. Your income tax relief got withdrawn of 18,600. On Tevira Limited shares, you paid CGT of 2,300. And on the gain of painting, you paid CGT of 12,000. So the after tax which you will take home is 62,100. So what you need to understand is that INS was selling EIS shares. INS was selling EIS shares within 3 years. INS was selling EIS shares within 3 years. INS was selling EIS shares within 3 years. Now, when you are selling the shares within 3 years, when you are selling the shares within 3 years, what is happening? The income tax relief gets withdrawn. Number one, the income tax relief gets withdrawn. The gain on sale of shares gets chargeable. And the gain which you deferred against the painting also gets chargeable. Okay? The gain of painting which you deferred against EIS shares also got chargeable. I hope that this clarifies. So if you look at this question as a whole, there was issue of CGT and trading income involved. Then there was some basis period calculation, and there were some rules of EIS. We are running out of time, so I'm stopping my today's discussion here. But what I want from you people is that you all should revise the summary notes. You all should revise the summary notes. Do a revision of the summary notes. Read out summaries so that your rules get revised. Okay? Read out all these summary notes. Okay? I want you all that before the tomorrow's session, you all revise the summary notes and you also revise the two questions which we did today. One was Thomas and the other question was that Porth Limited. Okay? So we will continue tomorrow, and in tomorrow's class, we will complete question number 4 of this March 2020 paper, and then we will move towards a new exam paper. Okay? So thank you for today, and I hope that you will do the revision of the summary notes and the two questions which we did today. Okay? Thank you. Take care.